I don't like these tariffs. I mean, I'm not going to tell you how much money I just paid in tariffs because all the equipment for my sailboat comes from the Netherlands and that's all taxed at 15%. So,
Well, Chris, we've been telling you to buy American all year, so this is on you.
Right, because we build so much here in America. Part of the problem.
yeah, Ryan should start a new sail. Ryan should make sails.
Well, Chris, shame on you for having an expensive habit. And well, I think the point is, though, did you pay the tariff?
Yes, I did.
Okay, so we're paying Chris too much, Bob.
Welcome to the weekly edition of the Payne Points of Wealth podcast, the podcast that addresses all the pain points that come along with creating, growing, and sustaining your wealth. Hosted by the family wealth experts of Payne Capital Management, Bob, Ryan, and Chris Payne. Please send us any questions or comments you may have to questions@paynecm.com. And please enjoy this week's episode.
You know, a lot of tariffs now are getting negotiated from their high starting point. So, Bob, I think the big question is the art of the deal work? You know, what Trump is doing here, is it brilliant? Is this 4D chess? And it looks like we are getting trading deals, and it looks like they're landing somewhere between 10 and 20%, depending on the trading partner, which is much lower than where a lot of those tariffs were threatened at.
Yeah, I mean, the threats were much higher, and it looks like the Trump administration settling in around 15%. I'm not sure why he didn't go for 20, right? But it sounds like he's going for 15. But, you know, I'll tell you, the one thing that I'm enthused about is it looks like right now we're annualized at about $400 billion that goes right into our treasury. It's the first move I've seen any government take in reducing the debt.
Well, it's almost like you rob Peter to pay Paul, right? We lowered the corporate tax rate over here, but then we had tariffs over here, which is obviously a tax that the companies pay when the goods come into the country, which is fine, right? I mean, at the end of the day, we need to pay the deficit down. So I'm with you on that. I think that is one of the positives that probably doesn't get accentuated enough. But it is kind of remarkable, right? You know, we go back 3-4 months in April, and everyone on the street, the professionals on the street, we use that quotes, we're calling for recession. Tariffs are bad. They're inflationary, which I still think they might be inflationary, but so far so good, right? The economy hasn't fallen off the cliff.
First of all, Ryan, I think Chris, I think you'll agree with this. Depends on which channel's economist you were watching.
That's actually not true. It didn't matter which one you were watching. Every economist was pretty sour on the market back in April.
I agree. The market's doing great, but I don't like these tariffs. I mean, I'm not going to tell you how much money I just paid in tariffs because all the equipment for my sailboat comes from the Netherlands and that's all taxed at 15%. So,
well, Chris, we've been telling you to buy American all year, so this is on you.
Right, because we build so much here in America. That's part of the problem.
Yeah, Ryan should start a new sail. Ryan should make sails.
Well, Chris, shame on you for having an expensive habit. And well, I think the point is, though, did you pay the tariff?
Yes, I did.
Okay, so we're paying Chris too much, Bob, is the point here. But it also brings up another point. If you look at wages right now, they are growing over inflation. They really have for the last 2 years. So there is an argument to be made here, and I don't want to see what you think about this, Bob, that because wages are growing over inflation, if tariffs are inflationary, which is possible, and the prices go up, consumers will actually eat that higher cost. What are your thoughts on that?
Well, so far that's been the case. So we've had wages rising right along with inflation. We haven't seen any negative or positive impact on inflation with the tariffs, but of course, inflation's a lagging indicator, and it's going to take a while for these things to work their way through the system. But there's no mistaking the fact that a tariff is a tax, and somebody's got to pay it. And ultimately, it's going to be the consumer. So I know that, companies are scrambling to absorb some, get their vendors to absorb some, but ultimately it's the consumer going to pay for it. And you're starting to see it in some places like a coffee shop. You're starting to see coffee prices go up, but that's, not just, tariffs, that's other reasons.
So if you like coffee or you're a sailor like Chris, so I think the hard question here is, we're hearing a lot about how, well, inflation hasn't really ticked up here. Will we invariably see more inflation? And I think that's a big question, Chris. What's your opinion on that?
Yeah, I mean, I think we will see inflation, but you made the point, Ryan, that we are also seeing wage inflation. So people are going to make more money. So I don't know how much of an impact it's really going to have. Plus, one of the things we haven't talked about is the fact that, part of these negotiations, particularly with the European Union, They've committed to 710. Was it 710 billion?
I think it's over $1 trillion. Excuse me, over $1 billion altogether. Correct?
Well, they're buying 750 billion of U.S. energy.
Right, but another like 600 billion on top of that. Correct?
600 billion, invested. But that's, again, nothing's in writing. This is all just agreed.
I think that actually, and it's supposed to be over time. So you can probably take all those commitments to buy American products with a grain of salt, is my opinion. I think great, sounds like wonderful. We have the trumpets are sounding and President Trump comes out saying what a magnificent deal it is. But I think that component of these deals probably isn't that real. But what is real is money is coming to the Treasury's coffers, and that pays down the deficit. To your point, Bob, and I think that is a big deal. But I think the big question here is, and my provocative take is, we're going to see inflation. It's a delayed reaction to your point, Bob, but it's going to happen at some point down the line, and no one's talking about that.
Right. I think it's funny that you assume that money's going to go to the Treasury's coffers and pay down the debt. If I know the American government like I think I do, I have a funny feeling that we're going to see more debt as the future goes on.
Come on, Trump's got his new plane from Qatar. I mean, he's good. He doesn't need to spend any more of the public's money. But no, I think the bottom line is, I think what Bob you said is absolutely correct here. I think tariffs are a delay, or inflation from tariffs is a delay, and there is going to be a point here in the near future, where we're going to see that uptick in inflation. And I think everyone's kind of getting lulled to sleep right now.
But I also think that the U.S. government, and more specifically the Fed, is not discounting that. That's shown by the fact that the Fed hasn't lowered rates yet, and they haven't committed to a point in time when they are going to lower rates.
Well, the Fed can't lower rates here. I mean, first of all, we have interest rates that are at normal levels, right? We're at normal levels with interest rates, and the inflation number, arguably, it is at the Fed's target if you take out, rents, and so they could make a case for that. But the Federal Reserve's job is not to do the bidding of the president of the United States. So unfortunately, Trump grew up as a developer, and all developers want to do is, borrow at lower rates. I mean, it's just not the way the rest of the economy works. And, if we have another big blow up, which we will have, some kind of bubble burst or some kind of black swan event, Fed's got to have the ability to come to the rescue by lowering rates. You lower it now, I think it's risky.
All right, Bob, if you're a betting man, so what I'm hearing you say here is the Fed will not cut come September, but the market's saying it's 60% odds that the Fed's going to cut in September. You're betting against it, is what I'm hearing.
I'm not making any bets. I'm just stating the fact.
I want your opinion, Bob.
We don't need the lower rates here. And I think it'll be really interesting Wednesday to hear what the Fed has to say, specifically Jerome Powell. I think he will be more dovish in his comments. I think he's, caving to the pressure a little bit.
Yeah.
But that doesn't necessarily mean they're going to cut in September. And then you're here. For me, I'm telling you, you don't need to cut. And be careful what you wish for. We cut 100 basis points and the interest rates went up. So, every contractor, every developer, everybody who's looking to buy a home has been asking me every day, Bob, is Fed going to cut? Is only going to be able to borrow more cheaply? The Fed cuts, you may be paying more.
I think you're absolutely right, Bob. But Chris, I think Bob is like a great politician. He didn't answer the question. He said he thinks the Fed shouldn't cut rates, but you didn't tell me, do you think you think they shouldn't cut rates, but what do you think is going to actually happen? That's what Chris and I want to know.
Well, I think the Fed may actually increase rates.
No way.
Nobody's talking about that, right?
Nobody's talking about that. I think that's completely out of the question.
I think you can make a case for them increasing rates just as much as you can for lowering rates right now.
Yeah, but the problem is inflation has kind of been benign, right? It's kind of stuck in the same place. So it really hasn't gone down much, hasn't gone up much, which I would say constitutes maybe a hold here. But Bob, I'd actually take the over-under on that. Is that how you say that correctly? I actually think the Fed will cut in September because of political pressure. I think at this point, Jay Powell has said that, look, if we have full employment, which we have, right? Unemployment, the number comes out on Friday, I believe. We should be at 4.1, 4.2%. That's a 50-year low in unemployment. And prices are relatively stable. Inflation's come down a lot. So unless we see a big uptick in inflation in the next month, which I don't think we will, I really think he's going to cut come September. I'll take the other side of that bet, Bob.
I think Trump really got him when he called him out on the over budget on the renovations of the Fed buildings.
I don't think he did.
Except for the one building was finished 5 years ago.
Yeah.
Yeah.
Once again, the contractor and Trump coming out again.
Yeah,
Kudos to Jerome Powell for pointing that out. But I think, the important lesson here is, and I think when you're building your portfolio right now, and this is what we think about for our clients, is don't count out inflation. And when you think inflation, think assets in your portfolio that are inflationary, right? Whether it's commodities, whether it's dividend paying stocks, real estate investment trusts that pay a lot of dividends. Ironically, everyone has money in technology, the growth trade, but we learned this in 2022 when interest rates skyrocketed. What didn't do well? That was technology growth. So you really want to reposition your portfolio in the anticipation we could possibly have higher inflation. And I would argue most portfolios don't have that component.
Well, all I want to say, and I just want to remind everybody of the Payne principle of wealth, that even though Ryan is very strident in his belief that inflation's going higher, fact of the matter is no one knows. No one can predict what's unpredictable. No one can know what's unknowable. And of course, what we have to watch is all these expert economists. As soon as they agree on what's going to happen, something else will.
So guys, I came up with the best business model for Payne Capital Management. We need to start raising debt, buy Bitcoin. And when the price of Bitcoin goes up, we have more collateral. We can raise more debt and buy more Bitcoin, which is because Bitcoin never goes down. But what's crazy about this, and this stat blew my mind, that $86 billion this year has been raised for that purpose alone by companies to raise debt just to buy Bitcoin. That's more than initial public offerings in dollar amounts that's happened this year. So Bob, is this the greatest business strategy of all time? Or are we on the precipice of one of the most magnificent bubbles ever? What's your opinion?
Well, it's amazing how that term MicroStrategy, because the company changed its name to Strategy, but the strategy of MicroStrategy is now like already in the lexicon of business. It's like Eric Trump is starting a company which is the Bitcoin miner. So he's taking this shell company, and they're going to continue to mine Bitcoin, but at the same time they're going to create a Bitcoin reserve, just like Strategy. So they're going to, when I spoke to the representatives of that company, I said, well, we're going to employ the MicroStrategy. I'm like, oh, so that's now a known strategy, right? You issue zero coupon debt or any debt you can, or get any fool to, lend you money. And then you go in and buy Bitcoin every day as you're mining Bitcoin at the same time.
Yeah. And this is a company started by a guy named Michael Saylor, who the SEC back in 2000, when the dot-com bubble burst, admitted creating false information or accounting information for their company. And now with this great quote unquote strategy, what's more arrogant than calling your company Strategy?
Yeah.
Right. So Chris, do you think this ends bad, or is this the future of finance? And Payne Capital needs to get on the boat. We could be called Payne Capital Strategy if we deploy this and we make, millions. I think we can make millions. What do you think?
I mean, I don't think there's anything wrong with this. I think about what happened in 2008, during the subprime mortgage crisis, where, major companies were leveraging their balance sheets, 3 to 1?
35 to 1.
35 to 1. I mean, this could not go sideways at all. I mean, we've never seen Bitcoin drop, right? I mean, it's been consistent all the way through. A great hedge against inflation.
Well, we've had huge drops in it, right? I mean, that's the problem. And this kind of reminds me, Bob, remember you and I were driving around in the year 2007, right? And there were all these vacant developments that had just been built and nobody was moving into them. Meanwhile, Wall Street was making billions in real estate. And what was happening is people were buying developments, buying homes. The price would go up. They would borrow against it. They'd buy another house, borrow against that, and so on and so forth. Remember, even a waitress down in Florida I was speaking to at that time had 10 properties. So is this something similar to that? Just a wild bubble like we've seen many, many times on Wall Street? Or are we really in a new era?
Well, it appears to me to be a momentum trade, speculative bubble. But I'm not even thinking about Bitcoin anymore because now I'm all focused on stablecoin. Much better name. Sounds better.
What is stablecoin? What does that even mean?
This is my very, very simple definition of a stablecoin, right? It's just some sort of cryptocurrency that trades with the US dollar and is backed by treasury bonds. Now, think about this. If I'm sitting in a bank, in a money market fund, I'm earning 4% interest. If I'm sitting in a stable coin, which is outside the regulation of the banking industry, I'm earning no interest, yet Circle earns all the interest on my money. So you kind of have to wonder, like, what's the big deal about having a stable coin?
So basically what you're saying, Rye, is these stable coins are like digital checking accounts, right? Without any FDIC insurance or any ability to earn interest. So the money market fund at 4% right now, you're basically paying a 4% commission to convert your dollars into a stable coin to make purchases.
That sounds like a typical Wall Street product.
Well, look, there is actual use case for this, right? If you're speculating in cryptocurrencies and you want to convert your money back into the system, quote unquote, into the dollar, you can easily put into a stable coin. Again, it is stable, hence the US dollar. And let's say you're paying someone in a foreign country that doesn't want the money to be recognized by the government. Maybe it's like Argentina, or a place where you don't want to pay taxes on it. So moving it into stable coin, which is a stable value, makes some sense. But I question, how big is that market? And number two, like as Americans banking, like I get points, I get rewards when I use my credit card. I get interest on money sitting in a money market fund, right? So it just seems to me like the hype around this is just so much greater than the actual utility.
Well, it's kind of really misleading. First of all, it's not stable. The dollar's not stable. Have you seen the dollar in the last 6 months? Have you seen what's happened with treasury bonds over the last 2 years? I mean, these are volatile markets, right? There's nothing more volatile than interest rates. Well, there is currency, right? So currency is the most volatile market in the universe. So you have something called a stable coin. So stable, clearly it's not. And a coin, it's not a coin, it's a ledger, right? So it's a total misnomer.
Well, the other question is, if you're randomly audited, they'll check to see if you're actually buying treasuries to back, because most of them are in US denomination. But that also creates another systemic risk. That's more money going into treasury bonds. So if you do get a run on one of these stable coins, that could be a huge amount of money that sells out of treasuries at the same time. And that's what we saw when a lot of these banks were unwinding back 2 years ago, right? We had a couple banks where there was a big run on Silicon Valley Bank. All these longer-term treasuries were sold at the same time. They were underwater on their portfolio, which pushed the price of treasuries down dramatically. So I think, to your point, Bob, there's a lot of underlying risks here that nobody really is thinking about. And that's typically what happens in a bubble. It's just like you've got blinders on to all the different problems that can happen. And a lot of it's because we have two generations that have never been through a real credit crisis, is my thesis.
Well, first of all, the banking system's been doing this forever. If you look at the average checking account or savings account at a bank, they call it a money market fund, but they're paying you 0.17% interest, right? So you didn't tell us you wanted the higher money market rate interest. I mean, even if you buy a CD at a bank, they roll it over by contract into something paying no interest. So, you really got to pay attention. And I just think that anybody who's dabbling in stablecoin or Bitcoin, they clearly don't know what they're doing, because I still don't understand it completely. But, I'm going to keep my dollars in my money market account, earning my interest. And, I've been able to pay my bills just fine for the last 72 years.
Bob's not going to be doing many transactions in stablecoin for the foreseeable future.
But I think the bigger picture here is, and I think that's what we look at when we're investing money for our clients, is the fact that speculation is running rampant right now, right? I even wrote in my notes this week that stablecoins were silly because it is kind of a silly concept, but there's so much money being poured into that market. And if you look at money supply right now, liquidity is extremely high, right? There's lots of money out there to buy lots of crazy things. So I think the point here is, when you're building your portfolio, to go back to the wise words of Warren Buffett, be fearful when others are greedy. This is the time you have to be very, very careful, right? Anything where you're getting outsized returns, it's crazy. Your friend's getting rich, you're not getting rich, as Bob likes to say. Nothing makes people angrier than that. There's no free lunch, I think, is the Payne principle you have to think about right now. So when you're building your portfolio, you have to be very, very wary of what's hot right now, not over concentrating your portfolio, what's hot in the moment, because at some point you live by the sword, you die by the sword. That's why diversification is so key, and that keeps you out of trouble when everyone's getting crazy and wild about a certain asset class or a certain area of the market.
It's not stable. It is not a coin.
Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, so it's time for the financial autopsy of the week. This is where we take a real financial case, we dissect it so you can make better decisions with your own financial plan. And Chris, you worked on a case recently. Why don't you break it down for us so Bob and I can dissect it?
So this is a couple that came to me, not because they're necessarily concerned about their investments. They were actually more concerned because they have a substantial assets and they're working with a major wirehouse. I won't mention the name. And they're getting no service. The advisor never calls them.
I mean, first off, it's a bull market. So should you really actually call your clients, Chris? Does that make sense? You could be out sailing. Why are you calling your clients? What's the problem with that? Why is it bad? I know it sounds obvious, but why is it bad not to call your clients?
Well, the big issue, and I'll just relate it to these folks, is that they have no idea, first of all, what's going on in their portfolio. They feel like they're not getting any kind of guidance. They don't know where they stand as it relates to their overall financial plan. And to put it in their terms, they told me they just feel it feels really unnerving.
Why do you think that's the case, right? The market's going up. So a lot of times I feel like maybe people are less inclined to care about service when they see their portfolio going up month after month. But what do you think the real issue is there? Why are they upset about that?
The real issue is that they're actually dependent on this portfolio to sustain their lifestyle. So they're actually taking money out to cover all their bills and expenses. And they just don't know if the money that they have is going to be able to sustain them for the long run, and if they're in the right investments to do that.
So, Chris, this portfolio includes an annuity. You think the commission was paid up front on that annuity?
I actually asked about that, and they were under the impression that they weren't paying any kind of commissions. I think actually the advisor told them there wouldn't be any fees, but as we all know, there's a reason they lock that money up for the first 6 years of owning that annuity, because they have to make up for the fee that they're charging.
Well, first off, that's the biggest red flag ever. Whenever an advisor tells you there's no fees, there's probably even more fees than less fees, right? It's actually even worse than you actually expect, because as we like to say, when it comes to Wall Street and fees, it's the devil you don't see is much worse than the devil that you do. And it means a lot of the cost is embedded in the portfolio. And Chris, did they suspect they were paying fees, or do they feel like they weren't paying fees at all? And clearly, when you break down the portfolio here, you did an x-ray of it. They were definitely paying fees.
I think they assumed it, but I don't think they understood what the consequences were.
What do you mean by that?
Well, particularly with the annuity, while you don't see the actual commission come out, the money's locked up for a period of time. They call it a surrender period. So basically, they won't have access to that money without some kind of a penalty until after a certain period of time. And I think in this case, it was like 6 years that they can't touch the principal on that. And they're getting very little interest on that annuity.
Well, Bob, that's what we see all the time, right? The problem with annuities is typically to get something, you have to give something up.
Mm-hmm.
And I feel like when you're retired and giving up your principal is one of the most dangerous things or decisions you can make when it comes to your money. What are your thoughts on that?
Well, that's one of my rules, right? Nothing illiquid, nothing that requires a K1. You really want to tick somebody off, have them make their accountant file a tax return extension and have to pay them because the K1 doesn't show up. But with annuities, all the return comes out of the annuity. It's taxable. I assume these folks are in a pretty high tax bracket, Chris?
Yeah, they are. Big time, like probably 35%.
But, it's just the way this thing is sold, right? These, investments are sold. They're not bought. So, if this clients didn't need advice, they could do it on their own. They would recognize that owning a liquid bond, like a treasury bond or a tax-free municipal bond, where, they'd have liquidity, they'd have income, especially tax-free income, it's a much better deal. But I'm sure when this thing was sold, it's like, it's guaranteed. Well, who's it guaranteed by? U.S. government? I don't think so, right? But they're allowed to say that.
Well, the other problem too is that these folks are relatively young. They're in their early 50s, so they're going to be retired for a long time. And the problem is, like, especially with this annuity, it's yielding like 2 to 3%. It's locked up for another 2 years. They're not even getting a market interest rate. So if they were to own like a municipal bond, they'd be getting a much better rate. So it's kind of like it's hurting the longevity of their money, which is the exact thing they're trying to avoid.
Well, that's a good point, because if you're getting 2-3% in an annuity, you have to pay taxes on it. You're really getting like 1%, and we know inflation is closer to 3%. So if you caught all that, the math of that is you're losing money over purchasing power over time, especially when you're younger. It's even more important that your money grows. And just go back to what Bob just said. The other issue is guarantee doesn't mean anything. It's a company. And if that annuity company goes out of business or they mismanage their portfolio, well, guess what? You don't get your income stream anymore, or you don't get your principal back. And to your point, Bob, like, how can they say guarantee? That's insane, knowing the fact that you could lose your principal. That makes no sense to me.
Well, also, right, going back to what you had mentioned about the taxes. So, because the gains on this annuity are tax deferred, in other words, you don't pay taxes until you actually surrender it. So if they want to change out when the new annuity comes to surrender in 2 years, like, it's not going to be like a couple $1,000s. It's going to be over $300,000 that they'll have to pay in income taxes, taxes ordinary income, which means they're already at a high bracket. So you tack on that additional income, they could be in a 40% bracket.
Bob calls that a buzzkill where he comes from.
But the beauty of it is, Chris, based on your analysis, they have enough money to, if they just get a reasonable return, right? Not anything else outrageous, something way below what we've been able to generate for the last 50 years, they're set for life. So I guess it's a matter of just getting all the ducks aligned to let them understand that not everything they have is a bad investment, right? There are no good investments, no bad investments. It's like what's appropriate, for them to get from point A to point B. And to me, it doesn't look like you have a tremendous amount of tweaks here, but some significant tweaks that'll make a significant difference, in being able to sleep at night, knowing that they never have to go back to work.
Well, kudos to them, because I think a lot of people right now with the market going up are maybe less inclined to see if they're in good shape or not, right? Oh, the market's going up, I don't need to worry about it. But really, now is the time to really worry, right? Because times are good, but at some point, times aren't going to be good again. And as Warren Buffett likes to say, my second Warren Buffett quote for the pod today is, when the tide goes out, you can see who's been swimming naked. And I really think that's the big problem right now. Like, they're in their 50s, but we see this with clients in their 60s and 70s right now, is because if you look at the other part of their portfolio that's not the annuity, is just taking an extraordinary amount of risk, which feels fine when the markets are going up. But at some point, when you have a bear market, that's a huge problem when you're down the home stretch for retirement or retired now. And you got to start thinking about that now, not when the levee breaks, to quote Led Zeppelin, Bob.
Well, I'm glad to hear Led Zeppelin being quoted. Because, last week you were quoting the Pink Pony Club or something like that. But anyway,
So Ron likes to party.
Hey, for all you baby boomers who remember Hill Street Blues like I do, in the words of Sergeant Esterhaus, be careful out there.
Hey, hope you enjoyed episode 213 of the Payne Points of Wealth. If you like our podcast, you love our podcast, please give us a 5-star rating on iTunes, Spotify. You can subscribe to our channel. Your support gives us the support to continue to do this podcast. And if this is on YouTube right now, you can like this episode, subscribe to the channel, click that notification bell. It'll be updated every week of all our new content. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.